The main purpose of Tesla is to help reduce carbon emissions, which requires low cost and high volume. We will also set an example for the automotive sector, demonstrating that the technology works and that customers want to buy electric vehicles. Elon Musk. Demand for electric vehicles, EVs, is slowing. While sales are at historic highs, growth has slowed dramatically over the last year. Let's get into more details. The automakers' response shows that they expect the slowdown to extend more than a few months. Those who can lower prices are doing so, and the largest corporations are reducing their capacity expansion plans. The electric vehicle industry faces three significant challenges that contribute to its current state of uncertainty. Firstly, the prevalence of high-interest rate car loans is compounding the already substantial price tag associated with electric vehicles. Secondly, while EVs are no longer confined to a niche market of early adopters, their prices remain approximately 30% higher than traditional vehicles, necessitating further cost reductions to appeal to a broader consumer base. Lastly, concerns about the resale value of EVs are dissuading potential buyers, prompting some to explore the used car market for electric vehicles. Despite these challenges, these uncertainties may present opportunities for investors, as the need for vehicle replacements and the continued push for reduced emissions suggest a sustained demand for EVs in the future. However, rather than upgrading to an EV when it is nice to have, consumers may only upgrade when it is a need, resulting in shorter purchasing cycles. According to the Financial Times, the EV market is transitioning from early adopter to mass market. Any industry experiencing this transformation will present new hurdles. Early adopters prefer to buy the most recent technologies, even if it means paying a premium. Mass market buyers are more concerned with practicalities such as pricing and, in the case of electric vehicles, driving range. To make electric vehicles more inexpensive, firms must acquire tremendous volume. Tesla, BYD, and other legacy manufacturers are on their approach to obtaining that size. For smaller enterprises, however, that point may be further away. Assume you're looking at minor EV manufacturers. In that case, a key thing to consider is whether they will ever reach a point where they can profitably build EVs, and if so, what efficiencies and economies of scale would the larger automakers have by then? Economies of scale are an excellent competitive advantage to seek for. Businesses who arrive first often enjoy a major advantage over those that come later. Opinions on Tesla's stock price vary widely, exemplified by the divergent perspectives from different financial institutions. Morgan Stanley has assigned a $400 price target, emphasizing the company's potential future growth, while HSBC values it at $146, focusing on the present state of the business. The disparity in these assessments highlights the different lenses through which analysts evaluate Tesla. One projecting into the future, and the other grounded in current realities. Analysts use various metrics, including earnings per share (EPS), revenue forecasts, and buy/sell/hold recommendations to guide investors. While these benchmarks offer valuable insights, they might not be sufficient for making well-informed investment decisions. Price targets, typically based on a 12-month view, consider factors like valuations, financial forecasts, sector trends, and overall market sentiment. Buy and sell recommendations imply potential market movement, whereas a hold recommendation suggests that the stock is reasonably valued or that there's insufficient information to make a decisive call. Investors should consider these perspectives within the broader context of their own financial goals and risk tolerance. If you base your investment selections on price goals or recommendations, you are allowing the analyst to direct your entry. But do you know anything about their timeline, their convictions, and what would cause them to change their minds? Creating your own narrative is a better method to make an investing decision. That way, you are aware of all the elements influencing the stock, and your decision to acquire it or not is based on research, probabilities, and your estimation of fair value. The termination of a $5 billion partnership between Honda and General Motors, announced just a year ago, underscores the evolving dynamics in the electric vehicle market. General Motors recently shifted its focus from specific volume targets to meeting near-term EV demand, prioritizing profitability. This change in perspective has influenced investor sentiment, leading to significant declines in self-driving EV and tech-related exchange-traded funds over the past 3 months. Despite these challenges, the EV market continues to exhibit growth. In the United States, the third quarter saw the sale of over 300,000 EVs, reaching a notable milestone. Similarly, Europe and China experienced sales increases of 14.3% and 22%, respectively, in September. China, being the largest global EV market, remains a driving force behind the industry's ongoing development. However, the sector is battling with dropping raw material prices, which have an influence on EV battery output. As EV demand declines, raw material costs have weakened. For example, lithium prices have fallen by 67% this year, while cobalt prices have dropped by 20%, more than halving since May of last year. Car manufacturers, like other industrial enterprises, hedge against commodity price variations, and the drop in demand has impacted the cost of components used in EV batteries. Several automakers have expressed concern about these difficulties. Volkswagen of Germany has decreased its profit margin forecast for the year, citing negative effects on raw material hedges in the third quarter, some of which are used in electric vehicle batteries. Ford has temporarily curtailed output at a unit that produces its electrified F-150 Lightning pickup truck. Nidec, a Japanese automaker, expects to lose money in its core e-axle business, reversing a previous profit projection. Even China's CATL, the world's largest EV battery manufacturer, encountered hurdles in September, including a declining market share and increased competition. It is unclear whether China's electric car sales percentage will continue much over the 20% objective in 2023, as sales may have been exceptionally high in anticipation of incentive phase-outs at the end of 2022. Sales in January 2023 fell sharply, and while this was partly due to the date of the Chinese New Year, they were over 10% lower than in January 2022. However, electric car sales accelerated in February and March 2023, reaching almost 60% of sales in February 2022 and more than 25% of sales in March 2022, bringing sales in the first quarter of 2023 more than 20% higher than in the first quarter of 2022. The slowdown in Europe compared to previous years can be attributed in part to the exceptional growth in electric car sales witnessed in 2020 and 2021 in the European Union. This surge in sales was a swift response by manufacturers to align with corporate strategies aimed at meeting the CO2 emission standards implemented in 2019. These standards covered the 2020 to 2024 period, with stricter EU-wide emission targets scheduled from 2025 and 2030 onwards. The surge in energy prices in 2022 had a mixed impact on the competitiveness of electric vehicles in comparison to internal combustion engine cars. While gasoline and diesel prices for ICE cars experienced a spike, residential electricity tariffs relevant for charging also increased in some instances. The elevated prices of electricity and gas had a broader effect on manufacturing costs for both ICE and EV cars. Some automakers argued that high energy prices could potentially limit future investments in new battery manufacturing capacity. Transportation accounts for around 23% of worldwide energy-related greenhouse gas emissions, with road transport accounting for 72%, according to the Intergovernmental Panel on Climate Change. In an effort to tackle climate change, governments around the world have imposed more rigorous emissions limits on light-duty vehicles, such as passenger cars. While the industry has historically reached these higher criteria by steadily improving internal combustion engines, ICE, vehicle aerodynamics, and tire technologies, new legislation in some automobile markets may necessitate a significant shift. Europe and China are poised to lead the way in electric vehicle adoption, with England and France planning to ban the sale of fossil fuel-powered vehicles by 2040. Germany is providing substantial financial incentives to encourage consumers to choose EVs. China, the largest automobile market globally, is set to mandate that at least 10% of new car sales be fully electric or plug-in hybrid starting in 2019, backed by generous government subsidies averaging $15,000 per vehicle in 2016. While regulatory measures play a role, sustainable EV adoption is expected to be primarily driven by economic factors, with widespread acceptance, likely once total cost of ownership parity is achieved. This transition is anticipated to happen later in the US compared to Europe and China, resulting in a lag in adoption. However, due to the global nature of the automotive supply chain, original equipment manufacturers, OEMs, and their suppliers should prepare for the shift toward EVs and away from internal combustion engine vehicles, irrespective of their geographical location. Anyways, what do you think of this? Please remember to like the video if you thought it was informative and helpful. Please leave your comments, subscribe to our channel, and check back for more thought-provoking videos.